let's move on to number 2 out of 5. And here we're talking about CoreShares, which is an entity which is underpinned by Grindrod Bank. It's a pref share ETF, PREFTX. That's the code on the JSE. This one tracks an index of preference shares, mostly issued by local South African banks. I hope I got that right. Units in issue, according to my calculation, coming in here of 268 million rand. That's if you take the current price and multiply it by the number in issue. That gives you a sense of the popularity of this one. The yield that this has been throwing out for a couple of years is somewhere in the region of 8%. So Nerina, bringing in here, that's what you'd expect, right? Because the bank pref shares, they went through a bit of a bad patch where there was some changes in the dividend tax rules that knocked them, and then they sort of fell out of favor a little bit. But they do offer a chunky 6-monthly yield. But I guess if it's held in this entity, then it's not as chunky as it was before. You get a little bit of smoothing.
Yeah, it pays quarterly dividends, so you're going to get dividends 4 times a year. The benefit of this one is that yield is actually linked to interest rates. So it pays a dividend.
Just remind us how that works.
So
it's the
a preference share,
exactly.
So the preference share really, it's the yield that it pays. And remember, this is a dividend that gets paid before ordinary dividends gets paid. So this dividend is linked to the prevailing level of interest rates. So if you're in a rising interest rate cycle, this is a great time to be owning preference shares because you're going to get a steadily increasing dividend yield on those.
Although it's a sort of a dual effect, though.
It is a little bit, but there's a specific sort of quirk around South African pref shares that's one of the reasons why I want to highlight this now. They've been trading at a steadily growing discount to their par value.
No one wants to own them anymore, so people have been throwing them away.
Exactly, and the reason for that really was that around the Basel III capital adequacy ratio and funding requirements for banks, there was a view that banks would not be able to use these as to the same extent as a funding mechanism that they did in the past. And what then happened was people thought, okay, well the banks would like to redeem these, but redeem them at a discount to par. What we then found, so all throughout 2015,
they haven't really been issuing any new ones.
No, and what you'll see during 2015, definite capital loss also incurring on these. And then in January we had an interesting situation. It's not just banks, by the way, that issue preference shares. We have several large corporates
that
also
are
in this index.
Are they?
Yes, absolutely.
ShopRite,
absolutely.
I think
There's a whole lot of them. Bright used to be in there, and Bright just in January redeemed their preference share and had to do it at par. And suddenly the market sort of sat up and said, but you know what, maybe the issuers will not be able to redeem this at this big discount to the par value at which they are trading. Here's an opportunity actually to get not only that good yield, but also have a bit of a catch up in terms of the discount that it's trading to the par value.
So just understand, these things though are perpetual. So
they are.
The core of these is the First Rand, Standard Bank, ABSA, and all the others. And they're not planning to, as far as you know, redeem them, but they might.
No, they would. I think they would like to, over time, maybe gradually buy them back. But the market has shown that it will not allow them to redeem those at anything less than par.
So there's no other problem with dividend withholding taxes. They've written all that away. They adjusted their yields in order to take account of the fact that withholding taxes have to be paid.
And as an investor, you would still pay your dividend withholding tax. So it would be the normal 15% that you would pay on that, but it is a dividend that you are receiving, not an interest, even though the value of that dividend is linked to interest rates.
There was one catch, and that was that African Bank was in there. That was the kind of issue that people said, well, look, this is all sunshine and roses. It was
We're
not going to see any more of those,
tiny amount. It was less than 1% of this overall index. So yes, it was in there, but you know, the size of a haircut that you took on able debt was a lot more than what you took on able pref shares. So you know what, we need to see it in the context.
That's right, because the pref shares only got marked down 10% or something. I don't know if it's all done. But look, it was just a bit of a little
and it's
electric
no longer in the index anyway.
That reminded people that maybe the issue wasn't totally dead.
But I think that's the beauty again of an ETF, is that you get this diversified basket. You're not just buying the preference share of a single issuer, you are actually buying a diversified basket.
Okay, so you're saying that for specific reasons now, the Bright thing was quite instrumental and quite interesting. The share chart there reflects the little bit of a settling back of rates. Now we've got a rate rising, so that might also help a bit. So your general view would be this is an interesting one. What's the time frame there?
You know what, for me, this is very much a view in terms of where you would like to be positioned in a rising interest rate cycle, but also if you are concerned about about equity performance. So if you're concerned about global growth slowdown, about equity market performance, this one is a very defensive investment. So for guys looking for yields in their portfolio or looking for a defensive equity investment, this one for me is great.
So you're going to go hot on this one?
I'm going to go hot on this one.
Okay, well, that's not me. I'm going to go not hot because I'm the guy who still thinks the equity market's got some recovery potential, but there you go, different views.